On the morning of September 15, 2008, thousands of Lehman Brothers employees arrived at work to find their access cards no longer worked. Overnight, the firm had filed for bankruptcy, the largest in human history, with over $600 billion in assets. By the end of that week, global stock markets had lost trillions in value. Credit markets had effectively frozen. Banks around the world stopped lending to each other because nobody knew who was solvent and who wasn't. Within months, the crisis had wiped out millions of jobs, collapsed housing markets across 3 continents, and triggered the worst global recession since the 1930s. All of it traced back to a single weekend, September 13th and 14th, 2008. When the US government made a decision that shocked Wall Street, the global banking system, and every economist who had spent the previous year assuming that a firm the size of Lehman Brothers was simply too big to be allowed to fail. They let it fail anyway. This is the story of how Lehman Brothers collapsed, and why the consequences were felt by people who had never heard of the firm. Lehman Brothers was not a young company. It was founded in 1847, over 160 years before its collapse, as a dry goods store in Alabama, before evolving into a commodities broker, and eventually one of the most powerful investment banks on Wall Street. It had survived the Great Depression, 2 world wars, the 1987 stock market crash, and the collapse of long-term capital management in 1998. It was, by any historical measure, one of the most resilient financial institutions ever built. By the mid-2000s, Lehman had become one of the largest players in a market that was transforming Wall Street. Mortgage-backed securities. The logic was straightforward. American housing prices had risen almost without interruption for decades. Banks were issuing mortgages to homebuyers, then selling those mortgages to investment banks like Lehman, who bundled them into securities and sold them to investors around the world. Everyone in the chain made money. The banks made fees on the mortgages. Lehman made fees packaging and selling the securities. Investors received returns backed by what appeared to be one of the safest assets imaginable: American real estate. The problem was that the quality of the underlying mortgages had been quietly deteriorating for years. As demand for mortgage-backed securities grew, banks had loosened their lending standards dramatically, issuing mortgages to borrowers with little income verification, minimal down payments, and in some cases, no documentation at all. These were later called subprime mortgages. Lehman didn't just trade these securities. By 2006 and 2007, the firm had taken on enormous positions of its own, borrowing heavily to buy mortgage-backed assets and commercial real estate, betting that prices would continue to rise. When they stopped rising, everything changed. To understand why Lehman's collapse was so catastrophic, you need to understand leverage. Lehman Brothers at its peak was operating with a leverage ratio of approximately 30 to 1. That means for every dollar of its own capital, it had borrowed and invested 30. In a rising market, leverage amplifies profits enormously. But it works equally powerfully in reverse. A 3% decline in the value of Lehman's assets was enough, mathematically, to wipe out its entire capital base. By early 2007, the US housing market had begun to crack. Subprime mortgage default rates were rising. The securities backed by those mortgages were losing value. Most major Wall Street banks recognized the danger and began reducing their exposure. Lehman, under CEO Dick Fuld, did the opposite, continuing to accumulate real estate and mortgage-related assets through 2007, apparently believing the downturn would be temporary. By early 2008, Lehman was sitting on over $60 billion in commercial real estate and leveraged loan assets that were declining in value by the day. In March 2008, Bear Stearns, another major investment bank with significant subprime exposure, came within hours of collapse before being rescued through a government-facilitated sale to J.P. Morgan Chase. The Bear Stearns rescue sent a signal to markets: the government would not allow a major Wall Street firm to fail. It was widely interpreted as a guarantee that Lehman, which was larger and more interconnected than Bear Stearns, would receive similar treatment if it came to that. That assumption turned out to be wrong. Through the summer of 2008, Lehman's stock price collapsed as markets grew increasingly skeptical about the firm's ability to survive its real estate losses. Dick Fuld and his team spent months attempting to find a buyer or a major investor who could stabilize the firm. Talks with Korean, Chinese, and American investors all ultimately fell apart. By early September, it was clear that Lehman needed either a buyer or a government rescue, and it needed one within days. On the weekend of September 13th and 14th, Treasury Secretary Hank Paulson convened emergency meetings at the Federal Reserve Bank of New York. The CIOs of every major Wall Street bank were called in. Two potential buyers had emerged: Barclays, the British bank, and Bank of America. Bank of America walked away and acquired Merrill Lynch instead, another firm on the brink of collapse. Barclays expressed interest, but required a financial guarantee from the U.S. government to cover Lehman's most toxic assets, to protect Barclays' shareholders from losses. Paulson refused. The government would not provide a guarantee. Without it, Barclays walked away, too. At 1:45 a.m. on September 15th, Lehman Brothers filed for bankruptcy. The decision not to rescue Lehman remains one of the most debated in financial history. Paulson and the Federal Reserve maintained they lacked the legal authority to provide the guarantee Barclays required. Critics argued the decision was a catastrophic miscalculation, that the government had spent months signaling it would rescue systemically important firms, and then abruptly changed course at the worst possible moment. Whatever the reasoning, the consequences were immediate and global. Within 24 hours, money market funds, considered among the safest investments available to ordinary people, began reporting losses. The Reserve Primary Fund, which held Lehman debt, announced that its shares had fallen below $1, what the industry called breaking the buck. Investors pulled over $300 billion from money market funds in the following days. Credit markets froze. Banks stopped lending to each other overnight because nobody could be certain which institutions were holding Lehman-related assets and how deep the losses ran. The panic spread to every corner of the global financial system within days. The collapse of Lehman Brothers is often described as the moment the 2008 financial crisis went from a Wall Street problem to a global one. But the crisis didn't begin in September 2008. It began years earlier, in the lending offices of banks, issuing mortgages to people who couldn't afford them, in the trading floors packaging those mortgages into securities nobody fully understood, and in the boardrooms of firms like Lehman that borrowed $30 for every one they owned to bet on assets that were already overvalued. Lehman's collapse was the moment all of those decisions became impossible to ignore simultaneously. The lesson most regulators took from 2008 was about capital requirements. Banks needed to hold more of their own money as a buffer against losses. The Dodd-Frank Act of 2010 imposed sweeping new regulations on the financial industry, and global capital requirements were significantly tightened in the years that followed. But the deeper lesson is simpler and older than any regulation. When an entire industry, lenders, packagers, raters, investors, and regulators collectively decides that a particular type of asset can only go up in value, the question isn't whether they're wrong. It's how long it takes for the price of being wrong to arrive. In 2008, it arrived all at once. Lehman Brothers no longer exists. Its remaining assets were sold off in bankruptcy proceedings over the following years. Dick Fuld, who had led the firm for 14 years, was never criminally charged. He has largely stayed out of public view since 2008. The U.S. government subsequently passed the Troubled Asset Relief Program, TARP, authorizing $700 billion to stabilize the remaining financial system. Most of that money was eventually repaid. The recession triggered by the crisis cost an estimated 8.7 million American jobs. Global GDP fell by trillions. Millions of people lost their homes. None of them had ever heard of a mortgage-backed security. If you want to understand the decisions behind the world's biggest corporate failures and their consequences, subscribe. There's a new one every week. And if today's story made you want to understand how the 2008 crisis actually worked from the inside, I've linked a book in the description, The Big Short by Michael Lewis. It's the clearest explanation ever written of what went wrong, told through the handful of people who saw it coming. Link is below.